Thinking of buying a business or selling your own? Pricing a business for sale can be tricky. What you think a business is worth and what the other party thinks it's worth are usually two different figures. For a buyer, the worth of a business hinges on how much profit it will make, balanced by the risks involved. In this video, we will tell you how to value a business. Before starting the video, please subscribe to the channel and click on the notification icon so you would get notified when we upload the next video. Number 10. Forget about capital assets when valuing your business. Unless you're a qualified chartered accountant or a financial wizard, you may have made the common mistake of associating asset value with business value. In fact, these two entities are completely separate. Here's the common misconception. Suppose your business has an office block worth $500,000, supplies and products worth $100,000, financial backing of $200,000, and a fleet of trucks worth $85,000. In total, you've got $885,000 in capital assets. If you were to sell everything now, that is the cash value you'd receive from selling, so that is what your business is worth. Number 9. Work out profitability by being aware of gross income and all outgoing payments. If the value of your business isn't measured in capital assets, then what is it measured in? Profits. A valuation of your company is all about the money you are making and the money you are likely to make in the future. A buyer wants to know how much they can expect to make if they take over your company. With gross income and outgoing payments, your own salary is included in that. However, we aren't talking about every cent you earn from the business, just your base operating wage. Net profit is what we are aiming for, but that isn't all we need. A business is not valued based on its income for a single year. We also need to consider two more important aspects for valuing your company: multiples. Multiples are longevity meters. You don't expect your company to go out of business in a year if it is worth selling. So how likely is it to keep going and earning investors or new owners money? In the small business world, multiples range from 2 to 10. This number depends entirely on the risk factor involved and the size of the business. Larger corporations with solid foundations and longevity estimated in decades or centuries are likely to achieve high multipliers. But for your common variety small and medium enterprise, a multiple between 2 and 10 is the accepted norm. You multiply your net profits by whichever multiple is reasonable for your company. Profitability adjustments. A company is unlikely to generate the exact same profit year after year. When valuing your business, you must determine the amount of growth or profit loss you can expect over your applied multiple. To do this, you'll need to examine historical financial data for your company, if you have it, your market's expected growth, and your competitors' progress. Number 8. Calculate the value. This is the step that everyone dreads, the actual mathematics required to calculate the value of your small business. It shouldn't take long if you do proper bookkeeping, but if you're in the middle of liquidating capital assets because you're getting ready to execute an exit strategy that involves selling your business, it may take you months just to get ready to do the math, said Jack Choros, finance writer at Sophisticated Investor. First, establish your net income. To do this, take your small business's gross profit and subtract all expenses. For example, suppose your business brought in $750,000 with $500,000 in expenses, equipment, travel, supplies, and salaries, and we're left with $250,000. Second, look at multiples. As mentioned before, the riskier or smaller the business, the lower the multiple you can expect to achieve. To work out your unique multiple, you need to accept that there is some guesswork and subjectivity involved. Number 7. Accept the will of the market. You may need to compromise on your figures if the market doesn't support them. If you need investment to survive, or you can't wait to sell, then you cannot afford to be stubborn with your numbers. A business is only worth what the market demands. If your industry has fallen on hard times due to coronavirus, for example, you may value your business at a much higher valuation than the market would. Things like timing and the greater need for your business within the marketplace still matter, even if your brand might be worth a lot more money or your accounting records may show that you are worth more. Business is always about leverage. You don't often get what you deserve, you get what you negotiate. Number 6. Price to earnings ratio, PE. Businesses are often valued by their price to earnings ratio or multiples of profit. The PE ratio is suited to businesses that have an established track record of profits. Working out an appropriate PE ratio to use can be driven by profits. If a business has high forecast profit growth, it might suggest a higher PE ratio. And if a business has a good record of repeat earnings, it may have a higher PE ratio too. As an illustration, using a PE ratio of 4 for a business that makes £500,000 post-tax profits means it would be valued at £2 million. How you arrive at the right number for your PE ratio can vary dramatically, depending on the business. Tech startups often have high PE ratios because they're usually high-growth companies. A more common high-street company, like an estate agency, will have a lower PE ratio, and it's likely to be a mature business. You can see quoted companies' historic PE ratios in the financial section of the papers. And as the shares of quoted companies are easier to buy and sell, they're more attractive to investors. Smaller, unquoted companies usually have around a 50% lower PE ratio than their quoted counterparts. Because PE ratios differ wildly, there isn't necessarily a standard ratio that can be used to value all businesses. Having said that, a business advisor might suggest a valuation of 4 to 10 as a PE ratio. Number 5. Entry cost. This is a simple one. How much would it cost to set up a similar business to the one being valued? You need to factor in everything that got the business to where it is today. Make a note of all the startup costs. Then its tangible assets. How much would it cost to develop any products, build up a customer base, and recruit and train staff? After that, think about savings you can make when setting up. If you can save money by locating the business somewhere else or by using cheaper materials, subtract that from the figure. When you've taken everything into account, you've got your entry cost and a valuation. Number 4. Valuing the assets of a business. Stable, established businesses with a lot of tangible assets are often suited to being valued on these assets. Good examples of businesses like this are those in property and manufacturing. To do an asset valuation, you need to start with working out the net book value, NBV, of the business. These are the assets recorded in the company's accounts. Then, you should think about the economic reality surrounding the assets. Essentially, this means adjusting the figures according to what the assets are actually worth. For instance, old stock depreciates in value. If there are debts that aren't likely to be paid, knock those off. And property could have changed in value, so refine those figures too. Number 3. Discounted cash flow. This is a complex way of valuing business, relying on assumptions about its future. The technique is suited to mature businesses with stable, predictable cash flows. Think of utilities companies. Discounted cash flow works by estimating what future cash flow would be worth today. You can reach a valuation by adding the dividends forecast for the next 15 or so years, plus a residual value at the end of that period. You calculate today's value of each future cash flow using a discount rate, which accounts for the risk and time value of the money. The time value of money is based on the idea that £1 today is worth more than £1 tomorrow because of its earning potential. Normally, the discount interest rate can be anything from 15 to 25%. Number 2. Industry rules of thumb. Buying and selling businesses can be more common in particular industries, so those industries might have certain rules of thumb that you can use as a guide. They'll be based on things other than profit. Let's look at retail. Rules of thumb here mean that businesses are valued on factors like business turnover, how many customers it has, and its number of outlets. It's a good way for a buyer to value business based on how they expect to shake things up and get operations to industry standard. Number 1. A valuation based on what can't be measured. This brings us round to what we said at the beginning. A business is worth what someone is willing to pay for it. Intangible assets mentioned earlier could be considered here, with negotiation skill playing a part too. If the business has desirable relationships with customers or suppliers, it might be more valuable to a buyer. If the buyer doesn't have a stable team behind them to take the business forward, a strong management team that won't jump ship could also add value. and each prospective buyer might see different risks, variably lowering the value. The key as a business owner is to preempt any risks and minimize them. Do let us know in the comment how much your business is worth. Thanks for watching.